Good morning, Governor. Thank you for joining us this morning. We have our National Council Executive Committee members joining us today. I just want to share with you one very small statistics. This is the largest ever attendance that we've ever had at an NECM meeting at 267. And I think it reflects the interest in your address and interaction with you. So we are delighted and honored and privileged that you have joined us. May I invite President Dr. Sangeeta Reddy to please deliver her opening statement. Dr. Reddy.
So once again, good morning, sir, and namaste. I want to first begin by thanking you so much, not only for your presence here, but the proactive and extremely positive role you have played in the country and the economy over the last few months. With over 260 days that have gone by in the midst of the COVID pandemic, many of us got to the point where they were tuning in every day to get updates on the COVID numbers. And I think it was a series of negative news that we kept seeing, despite our hope that India had herd immunity, India would recover fast, India would be better by July. Things kept getting worse. But the bright spots on the television channel was when we got the news that the RBI Governor is going to address. So I'm thanking you on behalf of all our members for the clarity, the pragmatic steps, and the complete positivity that you continue to spread. It's a great pleasure to have you with us in the midst of these really challenging times. And you have played this key role in transforming policy making at the central bank through your unconventional tools. You've managed the liquidity and also facilitated the revival of businesses during the COVID period. As you all know, the combination of the COVID, the tensions caused by our neighbors in the East, and the contraction of our GDP numbers is leading up to what one wise person called a perfect storm. And it's important for us to avert this crisis. Reviving the economy requires the adroit coordination of the stakeholders, the government, the regulators, and the industry. And as one of the most important constituents of this cycle, we are extremely happy to have you here with us, sir. We will briefly present the findings from the FICCI Dhruva survey, which give a quick insight into the mood and the tonality. And then I will continue to raise a few points from members. We'll request for your address, and then we'll have an interaction with members, if that's okay with you, sir.
No, it's fine. It's fine.
Okay. Thank you very much. Yeah. So I want to first actually once again congratulate you on what we believe has never been done before, is this beautiful management between low inflation, low interest rate, and stable currency. And you've done multiple steps, whether it was the repo rate cuts, the liquidity. This combination is something that we truly acknowledge and appreciate. We believe that the creative new formulas, your adoption of the operation twist, selling some short-term, buying long-term, this combination which some may have commented upon, but we realize how it made such a positive impact to liquidity. You have been a continuous and pragmatic voice, and FICCI has been engaging with various policyholders, with businesses, with the economy, with ministry. And many of our recommendations are reflective of this common voice. At this juncture, I will break in speaking for 2 minutes and invite Dinesh Kanabat to share a few slides, which, sir, will give you a brief reflection of the state and some of reflection on the sentiment. Dilip, can we have the slides, please? And while it's coming up, sir, let me just say that as per this survey, the biggest challenge reported by a majority of companies participating in the survey is really the dip in sales corresponding to last year. And I think your survey also showed the significant depression in consumer sentiment. Over to you.
Morning, sir. And if I can echo the sentiments expressed by the president on how much we value the initiatives which have been taken by the Reserve Bank of India, which I have also personally shared with you. The initiative of carrying out the surveys has been taken up by FICCI and Dhruva, and this is probably the 5th survey that we have undertaken since the lockdown happened. So in a sense, this is a moving target, shows how people's sentiments have been going over a period of time. And there are a few quick things which I would like to share with you. So for example, when we ask the participants, and there's a very, very broad spectrum of participants who participated in the survey, as to when do they expect the economy to be back to normal. In June, we had a set of numbers out there. And as we see even today in the month of August, 62% of the participants believe that it will take almost a year. And if you look at about 85% cumulatively, believe it's going to take more than 9 months for the economy to come back to rails. So a sort of a little bit of a pessimism which is out there which needs to be addressed. Dilip, if we can move on. The question is, what is the current capacity utilization that people are seeing post the unlocking? And again, more than 44%, almost half are saying that they are below 50% capacity utilization. And overall, if I see about 70% are sort of between 50 and 70 overall. So again, a very, very low capacity utilization. Yes, Dilip. Again, when we ask the people, I think the earlier slide you skipped, Dilip, unless you want to move on. Yeah. So what is the expected capacity utilization? Again, people are not very robust. They do believe it will continue to 60% or so believe that it will continue to be below 70% capacity utilization. Yes, Dilip, next. What is the impact of unlocking on the company's export? Most of them, 70%, believe that despite the unlocking, companies' exports have not taken shape, have not moved ahead. Very, very few, just about 9% are talking about an increase. A total 30% believe that increase is between 0 and 10%. So again, the unlocking.
We'll wind up.
Sure, perfect. Okay.
Last slide.
Yeah. So, and what is the position on the company's cash flows, which I think is the last thing you might want to? A positive impact. In June, 79% said the unlocking had no impact on the cash flows. Now that has reduced to 49, but still half of them believe that the unlocking has not resulted in a positive impact on the cash flows. Over to you, President.
So, sir, very quickly continuing, as Dinesh had said, while the unlocking helped to restart businesses, the damage which was caused by COVID-19 was colossal. And I think now we are seeing that there is beginning to be a realization that things will not come back to normal in the next 2 to 3 months. And with the movement of the announcement on the vaccines, it was supposedly November, it's moved to December, and now we're hearing February, and potentially it will not be before June, July that a significant number of people will have been able to take the vaccine or the 2 doses of the vaccine. So many of our comments and requests, which we will state a few of them now, and many of them are, and the interaction after you speak, are based on this input. But the biggest thing that we feel, sir, that it is important for us to do whatever we can to revive the economy. First was, of course, to survive the medical crisis, to survive bankruptcy, to survive and bring liquidity in. And you have played a tremendous role in that scenario. Now is an important period of being able to revive this economy. And for that, this aspect of finding ways for the liquidity flow, because on one hand, and we're tracking this very closely, sir, the moves by the RBI as well as by the ministry, the ECLGS scheme, the fact that 1.3 lakh crores has moved, that there have been sanctions of higher, but there are increasing number of people who say that they are not covered by this scheme. And this, I think, has been one of the largest voices or representations that can we include cooperative banks, the cry of the Nvfc banks. All these are beginning to create a sense of despondency in multiple sectors of people who have not been covered. Moving on, sir, I think that we are very thankful to you for the committee set up, the Kamath committee, and all the aspects on the one-time restructuring. We believe and we have a few recommendations in terms of reviewing of the eligibility criteria as well as the timelines laid out under the scheme, because we believe and have specific examples of several deserving accounts who are in dire need of support, who may not qualify, and who will miss out on this window of opportunity. We have given one submission. We will also share an additional updated detailed submission with you. Another area where we'd like your intervention and would like to call your attention, sir, is RBI's latest guideline on opening up of a current account. We believe that this may cause unnecessary disruption during these stress times by increasing the cost of borrowing and the operational workflow for businesses, and would request that you would consider amending the circular to allow more than one bank to be the payment vehicle. FICCI has been representing also to SEBI. And here we would request that RBI also adds to that if a certain guidelines on the pricing guidelines and the open offer guidelines, because access to capital is one of the most important things at this point of time. So the exemption required for listed debentures is also an important point which has come up, sir. We have found that one of the other significant areas that because the low rates of borrowing are available only to a few, the AAA rated companies, etc., that this aspect needs to be looked at of a larger basket of companies. Finally, one of the biggest fears, sir, is that the credit flow should not be crowded out by government borrowing. And the estimate is that the government is still going to need to borrow up to 8 lakh crores. So what will happen? Are we adequately capitalized for the needs of this country? And the needs of this country today and the needs of this country tomorrow as well, sir. So this is one thing. When we spoke about survive, revive, and then finally also to thrive. And here there are multiple sectors which are calling out for your attention, please. There is the education sector because students are finding it hard to pay their fees. There is subsidies which used to be given to micro irrigation. And if those subsidies are stopped, the impact may not be seen immediately, but what will happen in 6 months to 12 months from now? So there are many areas like that, sir. FICCI being a large and diverse membership, we have received feedback from everywhere, and we will share all these with you. But most importantly, our entire membership is very excited by your presence, very thankful for the proactive steps you have taken and your openness to continue to engage and to find every methodology possible to help the economy. So before you address us, I'd once again like to commend you for your foresightedness, for your future plans, for unveiling of the last monetary policy announcement, for your decision to set up an innovation hub for the financial sector, which is again highly pragmatic. We would request you to please look at one more aspect, which is the banking sector reforms. As our last and most important request, sir, is this fact, because we see a strong, self-reliant, over $5 trillion economy, and request you to be one of the important pillars of architecting that banking sector reforms with the relaxation in ownership norms, enabling international ownership or other ownerships, but relaxing in that, strengthening operations, talent, governance. So whether it's by a development bank route or any other route, giving India and industry the capital required to grow is what all of us are looking to you for. But once again, with a very big thanks for gracing the National Executive Committee of FICCI. Our members eagerly look forward to your views. Over to you, sir. Thank you.
Thank you, Dr. Sangeeta Reddy. And Thank you for the opportunity to interact with eminent business leaders of India and members of the FICCI. I can see so many familiar faces, and I have also very pleasant memories of participating in various interactive sessions in that beautiful hall in Delhi in the FICCI headquarters. And so it's good to see so many members of FICCI. So a very warm good morning to all of you, and to others who are also participating in this, who are attending this webinar, as they call it, and so many others, who would have logged in. So good morning to everyone. And I wish to thank the organizers for hosting this event, undeterred by this still unfolding pandemic that on a daily basis tests the resilience and capacity to save lives, households, businesses, and economy. The end August press release of National Statistics Office NSO was a telling reflection of the ravages of COVID-19. Nevertheless, high frequency indicators of agricultural activity, the Purchasing Managers Index, that is PMI for manufacturing, and certain private estimates for unemployment point to some stabilization of economic activity in the second quarter of the current year. While, of course, contractions in several other sectors are also simultaneously easing. The recovery is, however, not yet fully entrenched, and moreover, in some sectors, the uptick which was noticed in June and July, they appear to have leveled off. By all indications, the recovery is likely to be gradual as efforts towards the reopening of the economy are confronted with rising infections. The global economy is estimated to have suffered the sharpest contraction in living memory in April to June 2020 on a seasonally adjusted quarter-on-quarter basis. World merchandise trade is estimated to have registered a steep year-on-year decline of more than 18% in the second quarter of 2020 calendar year. And this is the estimate of the WTO. High-frequency indicators point to a trough in global economic activity in April to June quarter, and a subsequent recovery is underway in several economies such as USA, UK, Euro area, and Russia. The global manufacturing index and services PMIs rose to 51.8 and 51.9 respectively in August from 50.6, which is 50.6 for both in July. Yet infections remain stubbornly high in the Americas and are increasing again in many European and Asian countries, causing some of them to renew containment measures. On the back of large policy stimulus and indications of somewhat hesitant economic recovery, global financial markets have, however, turned a bit. Equity markets in both advanced and emerging market economies have bounced back, scaling new peaks after COVID crash in February and March. Bond yields have also hardened, and I'm referring to advanced economies now. Bond yields have also hardened in advanced economies on improvement in risk appetite, fueling shift in investors' preferences towards riskier assets. Portfolio flows to EMEs have also resumed, and this has boosted up EME currencies, aided also by US dollars weakness following the Fed's recent communication on pursuing an average inflation targeting. Gold prices moderated after reaching an all-time high in the first week of August 2020 on prospects of economic recovery. Financial market conditions in India have significantly eased across segments in response to front-loaded cut in policy repo rate by the RBI and the large system-wide as well as targeted infusion of liquidity, which you have referred to in your opening remarks. Now, despite substantial increase in the borrowing program of the government, and I'm now you can see that I had anticipated some of the points which you had made. So I'll just try to touch upon it as a part of my opening remarks. So, the Despite substantial increase in the borrowing program of the government, you can see that the persistently large surplus liquidity conditions which the Reserve Bank has ensured has facilitated non-disruptive mobilization of resources at the lowest borrowing costs in a decade. In fact, I was looking at the GSEC rates, and the current GSEC borrowing rates are perhaps the lowest in the last 10 years. And this is mainly because of the kind of liquidity which we have provided to the market. In August 2020, the yield on 10-year GSEC benchmark surged by 35 basis points amidst concerns over inflation and further increase in supply of government papers. Following RBI's announcement of special open market operations, which you referred to as Operation Twist, and other measures to restore orderly functioning of the GSEC market, bond yields have softened and traded in a narrow range in September. Although bank credit growth remains muted, scheduled commercial banks' investments in commercial paper, bonds, debentures, and shares of corporate bodies in the year so far, that is up to August, from April to August, they have increased by, please note the numbers, current year, the bank investment in all these debentures, commercial papers, etc., in the current year up to August 28th, they have increased by 5,615 crores as against a decline of about 32,000 crore during the same period last year. Moreover, the benign financing conditions and the substantial narrowing of spreads have spurred a record issuance of corporate bonds of close to rupees 3,20,000 crores during 2021 up to August. And here I would like to refer, there was a mention, you made a mention about that liquidity is not available to FICCIs and Nvfcs. May I sort of submit for your consideration that the liquidity line which we opened for all India financial institutions like NABARD, the SIDBI, and the National Housing Bank, now that has actually flowed to cooperative banks. It has flowed to mutual fund. It has moved to microfinance institutions, and some of it has also flowed to small NBFCs. So therefore, we have not, we have taken care of that particular segment of MFIs, smaller size NBFCs, and the cooperative banks. In fact, NABARD, even in the last announcement in August, we announced another 10,000 crore for NABARD. So we are constantly, and through SIDBI also, a lot of capital, lot of liquidity, liquidity has moved to various MSME and MFIs also. So, and we are in constant engagement with all these all India financial institutions like NABARD, SIDBI, and the National Housing Bank. And we are also very carefully monitoring the markets, and as and when required, further measures will be taken. I have said it earlier during my various statements that the RBI stands fully prepared. In fact, I had used the terminology that the RBI stands battle ready, and whatever measures are required will be taken up by the RBI. And here I must also like to take this opportunity to compliment and thank my colleagues in RBI who have been working day in and day out in supporting me and in facilitating many of these decisions, timely and proactive decisions. Now, the immediate policy response to COVID in India has been to prioritize the stabilization of the economy and support a quick recovery. Policies for durable and sustainable high growth in the medium term after the crisis, nevertheless, are quite important. And in my address today, I propose to dwell upon that issue squarely. What could potentially lift up India's economy to trend growth as the recovery begins? While interacting with members of the CII on July 27th, I had covered 5 major dynamic shifts taking place in the Indian economy. Number 1, fortunes shifting in favor of the farm sector. Number 2, changing energy mix in favor of renewables. 3, leveraging information technology, ICT, and startups to power growth. 4, shifts in supply or value chains, both domestic and global. And 5, infrastructure as the force multiplier for growth. Today, I would like to touch upon 5 areas, 5 different areas that I feel would determine our ability to step up and sustain India's growth in the medium term. Number 1, human capital, in particular education and health. Number 2, productivity. 3, exports, which is linked to raising India's role in the global value chain. 4, tourism. 5, food processing and associated productivity gains. Let me first touch upon human capital, the importance of, and with specific reference to the importance of education and health, and the need to take certain measures in these 2 areas. Now, investing in people adds to the stock of skills, expertise, and knowledge available in the country. The assignment of importance to education dates back to Plato, Aristotle, Socrates, and Kautilya. Its significance for economic development has received progressively increased attention in recent decades, especially in the work of several Nobel laureates, including T.W. Schultz, Gary Becker, Robert Lucas, and James Heckman. There has come about an explicit recognition of education as human capital in endogenous growth theory, backed up by cross-country empirical evidence. In India, states with higher literacy rates are found to have higher per capita income, lesser infant mortality, better health conditions, and also lower poverty. Education and skill development, however, contribute less than half a percentage point to our overall labor productivity growth. In order to reap the demographic dividend, we have to raise expenditure on education and acquisition of skills substantially. It is important to recognize that investment in education pays by raising average wages. In Global Education Monitoring Report of 2012, the UNESCO highlighted that every $1, that is every $1 spent on education, generates additional income of about $15. A World Bank report of 2014 showed that an additional year of schooling increases earnings by 10% a year. Higher education contributes to economic development through greater sensitivity to environment and climate change, energy use, civic participation, and healthy lifestyle. The new education policy, a historic and much needed new age reform, has the potential to leverage India's favorable demographics by prioritizing human capital. The goal to increase public investment in education sector to 6% of GDP must be pursued rigorously. And here, I think there is an important role for a public-private partnership also, which I would believe, and which I would like to sincerely believe, and which has been proved through empirical evidence, that education facilities created through public-private partnerships can, sort of generate quality education, can impart quality education at affordable costs while maintaining the financial viability of private investment. Indian banks and financial system would need to respond proactively to opportunities arising from the new education policy for new financing. Besides improving access to education, focus on quality of education is also very important. And, I have a prepared text of my speech. I'm not reading out the entire speech. It will be uploaded in the RBI website immediately after this session is over. So anyone interested can please have a look at the speech which will be uploaded, but I will just touch upon some of the points and then conclude and leave sufficient time for discussion. Health, similarly, is another vital component of human capital, and good health increases life expectancy and productive working years. In high-income countries, the per capita health expenditure is naturally very high compared to countries like emerging economies like India. I have the figures here. I'm just skipping that. Now, COVID has brought to the fore the importance of easy access to health services to contain mortality rate, given significant interstate and intrastate differences in health care infrastructure. And while laudable crisis time response to scale up health infrastructure has helped in dealing with the health emergency, I'm referring to India, a more comprehensive approach similar to the new education policy for health sector may also be warranted, which must also cover deeper penetration of insurance and also preventive care. Greater attention is required to improve the healthcare ecosystem by ensuring creation of new medical colleges, higher education, research institutes in the area of medical science, higher number of postgraduate seats, and setting up new colleges for paramedics and nursing. Let me now touch upon the second point, which deals with productivity growth. Now, by any reckoning, COVID-19 will leave long-lasting scars on the productivity levels of countries around the world. According to a very recent World Bank assessment, which was done in 2020 in the context of the pandemic, COVID-19 could entail adverse effects on productivity because of dislocation of labor, disruption of value chains, and decline in innovations. During earlier episodes of epidemics in the past, like the SARS, the MERS, the Ebola, and Zika, productivity is estimated to have declined by 4% over 3 years. The COVID impact on productivity could be expected to be much larger. And this is a worldwide survey which the World Bank assessment which the World Bank has undertaken. Now, CLEMS, which stands for Capital, Labor, Energy, Materials, and Services, a database hosted by the Reserve Bank, shows that India's economy experienced an overall productivity growth of 0.9% per annum on an average over a period 1980-81 to 2017-18. In the immediate post-global financial crisis period, that is from 2008-9 to 12-13, there was, however, a decline in productivity by 0.3% annually, while the period thereafter, up to 2017-18, recorded annual productivity growth of 2.4%. The contribution of productivity growth to overall GDP growth of the Indian economy over the period 80-81 to 2017-18 was about 15%. More recently, during 2013-14 to 17-18, its contribution, that is contribution of productivity, increased significantly to about 34%. The share of patents applied and granted to India in the total patents granted globally has been rising over the years, and this is another area, I think, which also requires attention. Stepping up R&D investment in other areas would require more efforts by the private sector, with the government focusing on creating an enabling environment. You see, most of the advanced economies and other countries, a lot of investment in R&D takes place by the private sector. In India, so far, it has been primarily public sector driven. There is investment. I mean, there are efforts being undertaken by the private sector, no denying. But this is, I think, one area where there are opportunities for the private sector. And I would like to utilize this opportunity to sort of appeal and to sort of mention to you for your consideration that I think private sector also needs to focus on research and development. Now, the innovation hub you have mentioned, Reserve Bank has launched it. We are not going into it. The India Innovation Index released by the Niti Aayog last year has been widely accepted, and I think that can act as a platform for more emphasis and more focus on innovation. The third point I wanted to touch upon is with regard to global value chains. Now, the impediments to global value chains have been identified in the post GFC, that is the post global financial crisis, and they are more. I'm talking about the global scenario. Globally, the key impediments to exports after the GFC global financial crisis, they include generalized increase in protectionism by trading partners, weak global conditions. Then you have automation and several other factors coming in. Notwithstanding these impediments and also the significant decline in trade intensity of world GDP growth in the post-GFC period, opportunities for expanding exports arising from vastly altered global landscape for trade, where more than 2/3 of world trade occurs through global value chains. Now, this is very important. You know, 2/3 of the world trade occurs through global value chains. And today, India, we are on the threshold of a big opportunity to break into the global value chain. And I think this is one area where government, all authorities concerned, and more particularly private sector, private industry, business need to work together. It is an opportunity available for Indian business to try and break into, to enter into the new opportunities, to capitalize the new opportunities which the current crisis has opened up, for new players to break into to become a part of the global value chain. India's participation in the global value chain is quite low and it can be improved. I'm not going into that any further. Now, among the sunrise sectors that offer potential for higher exports in the post-COVID period are, of course, obviously drugs and pharmaceuticals. And it's very heartening to note that many of our Indian companies are, they have sort of become global suppliers of various kinds of medicines and drugs. And this is an area where India has certain competitive advantages and that needs to be capitalized. A sharp policy focus on other global value chain intensive network products, including equipment for IT hardware, electronic appliances, electronics and telecommunications and automobiles would also provide the cutting edge to India's export strategy with considerable scope for higher value additions. Domestic policies need to focus on right mix of local and foreign content in exports while aiming to enhance participation in GVCs. It is also important to learn from global experience and nurture those trade agreements that go beyond traditional market access issues. Provisions relating to investment, competition, intellectual property rights, protection have a larger positive impact on global value chains, GVC trade, and need to be assiduously cultivated and integrated into the Indian ecosystem. Now, so therefore, I have touched upon three of these aspects. The other two aspects which I have listed out are tourism as an engine for growth. Tourism has been one of the sectors in the economy most severely impacted by COVID-19. At the same time, this is also a sector where pent-up demand could drive a V-shaped recovery when the situation normalizes. India, as you know, has tremendous potential in tourism, and the challenge, nevertheless, is to scale up our tourism market and enhance its contribution to economic development. The employment elasticity of tourism sector is very high, and it needs to be capitalized. I'm happy to note that a multi-pronged approach, a policy approach, has been taken up by the government, and this is one area where, again, the private sector has an important role. The fifth and the last point which I would like to mention, and the details are there in the speech, so you could perhaps have a look at it, and others also who are part of this webinar may please have a look at it in the RBI website, because I have given a lot of points and a lot of data and other things which may be of interest. Now, food processing for surplus management is also very, very important. And this is, so far as India is concerned, this is in fact a sunrise industry. Globally, its importance in consumer basket has increased over time, led by rising per capita incomes, urbanization, and change in consumer perceptions regarding quality and safety. Despite being one of the largest producers of several agricultural commodities in the world, India ranks fairly low in the global food processing value chain. There is therefore a need to move up in the value chain. And India can certainly move up in the global agricultural value chain by increasing its share of processed food exports, for which quality standards will be critical factor. This is again an area which I would like to submit for your consideration, and consideration of your members and others. That this is one area where I think Indian business and private sector can focus on and should make an effort to again make their presence felt in the global value chain. In my address today, let me now conclude. In my address today, I have highlighted 5 critical areas that can determine the shape of our post-COVID post-COVID trend growth. Now, I have highlighted these 5 areas, and these 5 areas should be read in conjunction with the 5 areas which I had earlier mentioned to the other apex industry body, the CII. So there are totally 10 points which I have highlighted, and I would like to believe that these are the areas where there are opportunities for private sector, and these opportunities need to be capitalized. I have highlighted 5 critical areas, as I have said, which can determine the shape of our post-COVID trend growth. While dealing with immediate crisis management challenges, we need to strategically prepare for our combined overriding goal, the pursuit of strong and sustainable growth. The private business sector has a critical role in each of the 5 areas I covered today. The enabling policy environment would evolve around the initiatives taken by India's businesses to seize these opportunities and actualize the potential of Indian economy as a rising economic power of the 21st century. COVID-19 has changed our lives, and it is increasingly clear that life will never be the same again. We should look upon these fundamental changes as opportunities rather than threats, converting them into game-changing new vistas of progress. I do sincerely believe that together as a nation, we can certainly do this and achieve our objectives. Let me conclude on this optimistic note. Thank you.
So thank you very much. Comprehensive, optimistic, and definitely what we were looking to hear. Since time is short, we'll jump directly into the questions, sir. But we have noted all your points. We'll go to the website, take the speech, and also add it into our website and disseminate it to our members. So may I make the first comment that I appreciate the inclusion of health into one of your focus and priority areas, being from that sector myself, and request for an inclusion into the guidelines. The Kamath committee did not specifically call out health, would request for that special focus on that one, especially because small nursing homes, etc., have had significant problems. With this, sir, I'll jump directly into questions. We're joined by many members of many of our past presidents, many seniors, chairs of many sectors. I'd like to call upon first Mr. Sudhir Jalan. Sudhir ji.
For giving me this opportunity. Governor Das, I would like to join our President.
Sudhir ji, we can't. Go ahead, go ahead.
Way it could be done, and your idea of come what may, that is a very reassuring thing. You have touched upon one about global value chain and food processing. I'm combining them because I myself represent a large sector of that industry. So the food processing has a multiplier effect on both employment and value chain. Unfortunately, one side you are giving incentive, but on the other side, the Commerce Ministry is withdrawing all the incentives which are being given to the food sector. The MEIS scheme which is being given for the agriculture sector has been reduced, and it has been said it will be removed from December. It will be a major setback to the food processing sector. I'd request you to take it up with the Commerce Ministry. The second point I'd like to raise is, sir, on infrastructure sector. Today, even in private sector, we see companies which have had a plan of investing. They put this on hold because they are uncertain of future cash management. So probably some way RBI should be finding out for giving a priority sector or giving a thrust to the bank to give them loans, or some way in which infrastructure could be built up. Because one side, if consumers are leading the demand, the other side of growth can come through infrastructure only. Thank you.
Thank you. call upon Dr. Jyotsna Suri, past President FICCI and Chairperson and Managing Director of Lalit Suri Hospitality Group. Sir,
Namaskar.
shall we do 3 to 4 questions and then you'd like to respond? How would you like to do this, or you want to do it one at a time?
I think 3-4 questions together will be better.
Because time is short. Thank you, sir.
Yeah.
Jyoti, please go ahead.
Thank you very much, President. Namaskar, sir. You yourself have really already understood what tourism and hospitality is doing to the country. And as an industry, we are very heartened to hear that you have recognized this as one of your pillars. We in the industry firmly believe that that this industry is going to be the tourism and hospitality will be the key driver going forward. So you gave us a moratorium for, I mean, as you're aware, this is a very capital intensive industry, and we are highly leveraged, all of us. We had a moratorium which of course finished, but what you really offered us was the opportunity for the one-time restructuring. So the one-time restructuring has a very tight schedule, and you've given us only 2 years. So it's not going to be possible for any of us to take advantage of that one-time restructuring unless we have a minimum of 4 years. So if that date could be extended to 2024 as against 2022, sir. The other thing, sir, is that some of the parameters, and particularly the ratios, are very, very tight and we will not be able to meet them, sir. So we request, if we've sent you a detailed note, sir, already, we would like the committee, and we've also shared this with Mr. Marishi yesterday, we'd like you to review this and give us an opportunity so that we can become one of your pillars, as you very rightly have said. Thank you so much, sir. Namaskar.
Thank you, Jyoti. Mr. YK Modi, please. And
Thank
sir,
you, President. Thank you, President. Governor Sahab, first of all, let me say that it's quite a pleasant surprise to have you as a governor, because you are the governor I have seen with open mind, open ears, and act very quickly. So I'll be not wrong to say in last 30 years we have not had a RBI governor like you. I have a small suggestion, sir, and that is that many companies may not like to take the restructuring, and they may dip into their reserves or raise equity to meet their financial obligations to the banks. But obviously they will not be able to meet the covenants or the ratios, etc. So those companies who make payment on time of interest and principal, at least for next 2 years, those covenants should be given a holiday. This is a suggestion from me for those who are not taking any benefit of any restructuring, etc. Thank you.
Sir, would you like to respond,
Yeah.
sir? Or shall I? Yeah. Okay.
Yeah, I think most of the points which were made by the respected members and all well-known and familiar faces. I think many of them are by way of in the nature of suggestions. I have noted down the suggestions. With regard to restructuring, let me just mention a general point. The whole rationale and the philosophy behind this whole rationale, the reasoning behind the restructuring scheme. You are calling it restructuring. We call it a framework for resolution of COVID-related stressed assets. You see, on the one hand, I mean, it had to be a very, very careful and balanced call. It had to be a very balanced decision on the part of the Reserve Bank. On the one hand, banks, the primary objective of banks, I should not say objective, but the primary concern of any banking system should be the protection of the depositor's interest. Because ultimately it is the depositor's money. And let me mention that depositors run into crores, whereas, crores of people, they are depositors, whereas borrowers could be in lakhs. Now, there are small depositors, there are middle-class depositors, there are retired people who depend on bank deposits. So the protection, the interest of depositors had to be protected. Also, the aspect of financial stability of the banking sector needs to be also kept in mind, because banking has an important role to spur economic development in an emerging market economy like India. Going forward, the banks have a major role, and in the context of COVID also, the banks are in the forefront of providing credit. So on the one hand, we have to keep in mind the requirement of the deposit, the interest of the depositors, protection of depositors' interest, the need to maintain financial stability, the stability of the banking sector. We don't want a repeat of the situation which India experienced some few years ago, 4 or 5 years ago, where the NPA levels of banks had gone up very steeply. On the other hand, we are also equally mindful of the fact that COVID has substantially affected, adversely impacted, negatively impacted large number of businesses, and particularly businesses which have availed loans from the banks. So therefore, they also needed some relief. Naturally, businesses which are otherwise viable, but because of temporary disruption in activity, they have genuine cash flow problems. So the focus is to assist, to enable such of the businesses which are otherwise viable, but which are facing problem in terms of cash flow drying up. The emphasis is to enable these companies to come back to normalcy and to resume their activities. So both the sides had to be matched. And in fact, the revival of business, on the other hand, also what I just mentioned, revival of such businesses will also ensure that the NPA levels are kept low. It will also ensure a quicker economic recovery. So we have to take a very balanced call. And I'm happy to, you are all aware that we appointed a committee of eminent persons with knowledge in the field of banking and public policy making, led by, Mr. K.V. Kamath, and the other members are equally eminent people in the field of banking and other areas and in the financial world. So they have come out with certain recommendations. After I must compliment them that in 30 days time, they were able to carry out extensive interaction with various stakeholders, including business associations, business bodies, and after extensive consultations, they have come out with this framework. And so this is the broad rationale I wanted to explain with regard to the COVID framework. All the other suggestions, all the other points which you have made, whether it is for healthcare or, there was a point relating to food processing and, the certain aspects of the restructuring program. I have made note of the points, and we will examine them internally. Thank you.
Thank you, sir. We are truly appreciative of your setting up the committee, KV Kamath committee, and the speedy resolution. And we appreciate, sir, it's being well discussed that the crisis that we got into in 12-13, where almost 7 lakh crores worth of NPL, and that dragged on with its scenario, whereas knowing that we could have had a similar quantum of problem now, you were proactive in setting up the committee. The restructuring will ensure that we don't get into a similar situation. We're very, very cognizant of that and appreciative of that, sir. With this, may I call upon Mr. Harshpati Singhania, then Sanjeev Somani and Ajit Ranade.
Shaktikanji, my compliments once again on doing a great balancing act and wonderful to see you. Sir, I just want to make 1 or 2 observations very quickly. Our President Sangeeta Reddy did point out that while interest rates due to liquidity have come down and sometimes to record lows, they are accessible to, that record low is accessible to only very, very few borrowers and companies which, are really AAA rated. So, yes, we understand there's going to be a difference based on the rating. However, what is happening is it is enabling the strong to get stronger in some ways. And even companies which are below AAA, maybe AA or A+, are not being able to avail this, not to speak of this. So we have to see how this can be resolved. That's point number 1. Point number 2, sir, is this ban on opening of current accounts outside of consortium. Again, a point raised by our FICCI president. So there are practical issues. We understand why this has been done to prevent misuse, if I may say, by corporates. And that is correct. However, what happens is there are several banks who are able to give corporates certain facilities at much more competitive or lower rates, which are not possible by the consortium members. and therefore it sort of places an artificial restriction and increase in costs. So may I suggest if that may be reviewed, or even if it is within the lending group, maybe the 10% minimum lending may go away, and any bank, private bank within that could be considered. And last but not least, sir, is a thought that this issue of waiver of interest or the interest on interest matter which has been going on, maybe a consideration can be made that, let us say, the interest payable in 2021 can be accumulated and made into a term loan for, say, 4 years or so, which can be serviced, say, at even a 1% higher interest rate. That will deter people from unnecessarily availing of it and give them the incentive to pay early, but yet give the facility and availability to people who would genuinely need it. Thank you, sir.
Sandeep Samani. Our past president, immediate past president, Sandeep Samani.
Good morning, sir. Thank you for always being there for industry and trade as a constant pillar of support. Sir, I just had one point. After the pandemic hit, the RBI had in a very timely manner asked the banks to reduce the margin money which the banks were keeping for loans of working capital. Normally, this used to be 25% of the working capital disbursed, and most banks have now reduced it to 10%, sir. This was a great help in these difficult times. And now, sir, as per the RBI circular, this policy expired on 31st August, and the banks have to normalize the margin back to 25% by 31st March of 2021. My request, sir, is that business is not usual in any manner currently. COVID cases are continuing to rise, and there is a lot of suppressed demand. If this, sir, could be extended by 6 to 12 months, the process of normalization and bringing the working capital margins back to 25%, it would be great help to industry, sir. And the best part about this, sir, on the extra drawing from the companies, the banks are making further interest. They are earning interest. So this is not a bad scheme at all, sir, for anyone concerned. The corporates are getting a larger lifeline in these difficult times, and the banks are earning money on the increased drawing power of the corporates. Thank you, sir.
Ashutosh Chadha, MasterCard.
Good Ashutosh here from MasterCard. So, Governor, sir, thank you very much for the time that you spent with us. And obviously, I second all the comments provided previously in terms of the support that the RBI has given to the economy. Sir, just one small piece. The RBI has with a lot of interventions to more digital transactions and payments. And we've seen one thing which is actually zoomed and increased immensely over the last 4 to 5 months, which is digital payments using online transactions as well as contactless payments. There is, however, one issue which is concerning a lot of us from the payment industry, and that is there is an RBI circular which was released in January of 2020, which required that all credit cards, debit cards, and etc., which are being would now be mandated for security purposes to be switched off for online payments and contactless payments. And individuals would need to then approach their banks or the banks to actually request. We feel that in the current circumstances, where people are moving to contactless, they're moving to online transactions, this could actually create a certain amount of friction in adoption. And we feel that there are lots of processes which are anyway being created by not just the network but issuer banks.
We have to be brief. Ashutosh, we have to be brief. The governor has given us 10 minutes above time, please.
So our request is if we could relook, and the deadline for this thing from 30th September. Our request as the payment industry entirely is to relook at this and possibly extend the implementation of this framework till at least next year, so that we can actually see a further increase in stabilization of online payments and contactless payments.
Okay. Sir, the last question will be from Mr. R. Govindan of L&T. And then with your permission, we'll hand over to you, and then our Senior Vice President will give a formal vote of thanks.
Can I come in, please? It's a very important point I want to make to the Governor. I'm George Muthoot. Just one.
Mr. Muthoot, one line, please, and then Mr. Govindan is the last question.
Respected Governor, Reserve Bank of India, I'm MG George Muthoot, Chairman of the Muthoot Group. Our flagship is Muthoot Finance. We have 78 crores customers so far, and that is including the repeat customers. We are having 70% of our 5,500 branch in rural and semi-urban. And there are so many people who are benefited by our financing at this time. And we are now stuck with three things. One is branch expansion. RBI, regional officers are not giving permission. If at all they are giving in a different fashion where we cannot open. They have to have the address before opening, but that will be very difficult for us to finalize with the landlord. Number two, the priority sector benefit was there for NBFCs. Ours is a gold loan NBFC. We are the largest in the country, and
Mr. Muthoot, thank you.
And
please finish. Please finish.
We are beyond 90% of the bank. It's not a level playing ground. At least everybody should be 75 as per ABM Rao's finding. So I will say only these 3 points.
Thank you.
Govindan here. Good morning, sir. I think I want to thank the banking system for supporting the companies so well during this period. I think I want to appreciate that. The 2 small points, sir. One is on that current account circular of RBI. I think Mr. Singhania talked about it. I think it is creating a lot of challenges in the digitization. It leads to confusion, leads to lack of competition. Maybe there is a need to redo the circular. So the intent is very good. We would like to, from FICCI side, I think we can find ways to work with you and find the better ways to implement it. This is one. Second is, sir, most of the companies work through a system of consortium of banks. There are no time limits on how well the decisions can take place in the consortium. So what we think is that maybe RBI should direct the consortium banks to either 60% by number or by value. If the decisions are taken in that framework, it should get automatically done. Otherwise, what we are realizing is that it's taking more than a year to get proposals through the consortium banks nowadays. Maybe some direction may be helpful, sir.
Madam, may I highlight about green finance?
Mr. Singh, I'm very sorry. The Honorable Governor has to leave. So we'll look for his response, and then our Senior Vice President will give a formal vote of thanks. We'll collate all your feedback and send it to his office. Mr. Das?
Yeah, thank you.
But if you have 10 more minutes, we would of course be very grateful, but we understand your schedule.
No, I have, but thank you. I mean, I have another meeting to catch up now. I'm slightly delayed, but it's okay. So therefore, I think mics may be put on mute, please. I would request some of the mics are on probably. Thank you. Now, I wish I had a little more time, but I have to catch up with my next meeting. So, but I would request you, many of the points which have been made by the members, and in fact, it so happens that I think I almost, I have interacted with almost all of them, and have interacted with most of them over the years. So I would request that FICCI of Secretariat to, sort of collect all these points and suggestions and send it in a consolidated manner to RBI. And I assure you that we will look into all the points and we will examine all the points and see what can be done. Now, the points which were made today also, most of them were by nature of suggestions. Some of them were requests for modification of certain decisions taken by the RBI. So I'm not going into all the points, but I will just touch upon 3 or 4 points. So one point was made, I think, with regard to the low rates. That is the low borrowing rates being available only for the AAA rated companies and not for others. Now, obviously, the spread over the spread at which a AAA rated company will get and the spread at which a BBB rated company will get the money from the market, naturally they will differ. I mean, you are aware of this. But having said this, let me say that if you compare the pre-COVID, that is before March 27th, in fact, I gave the details in my August 6th statement, the last monetary policy statement which I made on 6th August, and the statement is still available in the RBI website. In all categories of borrowers, whether it is AAA, AA, or even investment grade, or even the lowest investment grade of BBB minus, the spreads have come down over the last 3-4 months. Naturally, the reduction in the spread in AAA rated companies is more, and the reduction in spread in BBB or BBB minus, it is less. It is, that is because of their the risk perception of the risk assessment of the investor. But nonetheless, because of the liquidity measures that we have undertaken, and directly through repo operations and also through all India financial institutions, the borrowing costs, even for BBB, even for the lowest investment grade bonds, have come down over the last few months. The second point I would like to mention is that with regard to gold loans, I think this point is made time and again. You see, why this branch opening, every time the Nvfc has to come for a permission, whereas a bank doesn't need to come for a permission, or in the matter of LTV, that is loan to value ratio, for banks it is 90%, and for Nvfcs it is it is 70 or 75%. Now, let me just briefly explain why. You see, in India, with regard to the Nvfcs, RBI all these years followed a light touch regulation policy. The regulatory guidelines, the regulatory policies of Reserve Bank were much more stringent in the case of the commercial banks. Whereas in the case of NBFCs, we had a concept of light touch regulation. But then we had the unfortunate incident of the IL&FS crisis, and the crisis which was created in the entire NBFC segment. So right thereafter, in fact, if you see right from the beginning, from January of 2019, we have slowly been sort of bringing in new regulations to govern the NBFC sector. We have prescribed LCV, that is that they must have liquidity coverage, LCR, not LCV. They must have liquidity coverage ratio. We have also, fine-tuned several other regulatory requirements. We have insisted that they must have chief risk officer posted, and so many other measures which we have undertaken. So the fragility, the vulnerability of the NBFC sector is the main concern. They're still not at par with the banks in the matter of regulation. And we don't want a repeat of a crisis of, in another NBFC. If you recall, last year in the month of March or so, in March or April, I think in April 2019 MPC, I had made a statement that it will be our endeavor to ensure that no large NBFC fails. And thereafter, we have been very intensively, rigorously monitoring the top 100 NBFCs. Consciously, we have kept it at 70%, because for such NBFCs which give gold loans, it represents almost entire business for such NBFCs. So any sort of volatility in gold prices can completely undermine those NBFCs. Whereas in the case of banks, gold loans are only a very small fraction of their total lending portfolio. So that is the difference. I mean, I can see that there can be a difference of opinion, but I just thought I must explain this background. You say that the NBFC sector has also responded positively. Other point which I would like to, I think somebody needs to put on. The other point which I would like to mention is that with regard to consortium of banks that the time taken is very much, yes, that is a concern. Banks are commercial organizations. We cannot interfere. RBI as a regulator cannot interfere in how much time he takes for appraisal, but we keep on impressing upon the commercial banks, the scheduled commercial banks, to take timely decisions. That is by way of, but these are commercial decisions which they take. But I would like to draw your kind attention to the fact that in the context of the resolution plan, which we have now announced on 6th of August, or for example, the resolution circular which we issued last year on 7th June, even in the current resolution framework, we have specified timelines. We have said that if 70% of the borrowers, of the lenders, they agree 70%, I think, in terms of amount, and I think 70 or 75% in terms of amount, and 60% in terms of number. And we have given time limit also, that within so many days it has to be finalized. So this is in a special context. We have done it in the context of COVID-19 resolution, but to extend it to, to prescribe such time, I think it will be micro regulation. RBI should not enter into such micro regulation. But I have noted your point, and I think this is a point which the IBA, the Indian Bank Associations, needs to deliberate and act upon. And one more point before I conclude this, I think many of you have spoken about this RBI circular on the current account opening. Now, you know the reasons why it was done. Now, a lender, a bank which was lending to a particular client, was not aware. This no objection thing has not worked. There was a requirement that to open a current account in another bank, he needs a no objection from the lending bank, but it has not worked. Notwithstanding that, many banks have opened current accounts and have extended, banking facilities. So it did not work. So therefore, we feel that the current account, the lender, a bank which has lent money either by way of working capital or by way of a term loan, should have a clear picture about the cash flow of the borrower. Now, unless that happens, the lending bank will not be in a position to know how much, how much is the income, how much cash is coming in, how much cash is going out. So therefore, it creates a big problem for the banking sector. So this decision was taken in that background. That is the rationale I have explained. You have explained certain operational difficulties. We will see what operational difficulties you are mentioning, and I will have it again examined by our officials. So I would like to stop here before I hand back to the Vice President, Senior Vice President. Let me just once again thank all of you for very patiently participating in this. You see, today, the revival post-COVID or during the times of COVID, I think it has to be a joint effort by the government, by regulators, and by industry representatives like you, and by every stakeholder, by everyone who has a stake in our economy. India has tremendous potential. India will certainly bounce back, but I think all of us need to act together and act in time. Thank you very much for giving me this opportunity.
So let me just say thank you that we share your optimism, and as RBI stands battle ready, the industry stands along with you in the fight for India. Uday Shankar, over to you.
Thank you, President. Governor, thank you very much for a very open and very candid conversation with this group. This group, as you are probably aware, the NECM of FICCI, is, to my mind, the best capture of the entire physiology of Indian economy and value creation. So, sir, if you see a very diverse range of concerns and questions, it's on account of two things, because they capture the entire range of concerns that this country is going through. And two, it's also because you bring in an air of optimism and positivity. This group is not so open and forthright with a lot of other interactions, but with you, it's the case. We have noticed how you and the institution that you lead has risen up to the occasion during this whole pandemic crisis. In order to not take too much time, I only want you to appreciate, sir, that there is still a lot of fear and paranoia. You saw in our survey that people are really paranoid about return to normalcy, and there is no clarity on when it will come. And at a time like this, the Reserve Bank not only has the role to stabilize the entire financial sector and make sure that the revival is faster. I would only urge that the incentives for value creation, both social and economic, should never be undermined in the process of the handling of the larger crisis, because that, God forbid, might just extend the crisis further, sir. And in the process, the RBI and the financial sector under your leadership was in the process of a restructure when the pandemic forced a halt. And it would be a great opportunity to continue to accelerate that whole process of restructuring so that when we come out of the crisis, we come out faster and we come out stronger. Thank you very much for your openness, sir.
Thank you.
Thank you, sir. We appreciate, and we'll be sending you the document. Namaste on behalf
you.
of everyone.
Thank you, Shridas. Thank you very much, Mr. Das. Thank you.
Sir, thank you.
Thank you. I'll log out now. Thank you very much.
Thank you, sir. Namaste.
Thank you indeed. Thank you.
Thank you. Thank you.
Thank you all, members. Thank you very much for your active interaction. I apologize for those who could not